Welcome, welcome. Right, just give me a minute. Let's get everything set up. I think the market today is really, I guess over the last 2 days, the market is really having a sell off. I think before we go into the stream proper, let me just take a look at the markets. I think you can see literally everything is red. Let me move myself over here. SoFi down 5%. Hims is it's not too bad. It's down 1.2%. I mean, all things considered, I think that's not bad. Robinhood down 5.6%. Grab down 2.4%. Oscar is down 8.3%. Wow, okay. That's sudden after being up so much over the last couple of days. Nvidia, and I guess it's normal. Yeah, I guess if you look at Oscar, RSI is pretty, it's pretty neutral. Nvidia down $169. AMD down $158. Okay, that's good. I think I think soon we are able to start to deploy some cash. ASTS, when this was at the $60 range, I never ever thought I would get a chance to buy it again so quickly in the $30 range, because that's where I'm hoping to actually open a position in ASTS. You just bought, hi, Mr. Aston. You just bought more hymns and SoFi. I mean, that's great. I haven't bought any hymns and SoFi. I think in future I will do a little bit more explanation on how I run my portfolio using the live streams beyond what I do now. I think maybe let me just share my post on X before we get started. Give me a minute. So I've been challenging myself to make it a habit to post on X more frequently. So I've been tracking my portfolio there every single day. Started last week, so this is actually day 7. So apart from the weekends, I will at least try and track my portfolio there. I think personally, like me, I don't really have this habit of making use of social media in general. So I think I wanted to buy more hymns and SoFi, but actually if you take at my yesterday, but I held off. Firstly, I don't usually like to buy on the first rate day. I like to allow the rate days to continue to let the bleed really happen before I buy. But I think secondly, if you take a look over here, in terms of cash in my account, I have around $129,000 left in cash. Currently, right now in SoFi, I have 20 cash secured puts at $21. So they are pretty close to executing. SoFi is $21.66 today. Right. So these 20 cash secured puts expire 29th August, and then the same thing, 20 cash secured puts at 20 also expiring 29th August. So on average, I'm getting 4,000 shares of SoFi at around $20.50, received about 50 cents on each side of this. So because of that, I think the average price of SoFi that I'll be buying SoFi at is around $19.50. But this already takes up $82,000 in collateral. And then on top of this, I have HIMS. I have 10 cash secured puts on HIMS at $45. This is expiring 19th of September. So this takes up an additional $45,000. But because this is 19th of September, it's still quite a fair bit away. I think because of that, what I'm likely to do is to allow just one of my cash secured put of SoFi to eventually get assigned if it really does by the end of next week. Otherwise, I might close one early and then basically use that money to buy HIMS, especially if it drops below $40. I think despite all the concerns around regulations, around lawsuit, I think HIMS at in the 30s or even in the low 40s is still representing quite a good deal compared to some other companies that we have in the market. And so that's basically where my head lies. And I think I was just scrolling on X. Yeah, and I think towards the end of yesterday's stream, a lot of people were asking me about SoFi and actually what I felt about the drop and the business in general. And I heard many people on Tanner's stream. If you listen to Tanner Future Investing, people were really concerned, and I think this post really sums it up for us really well. This is that only in SoFi's fashion can we have positive news, numerous price target raises over the last 3 days, and proceed to have a 10% pullback. So, like you said, small pullbacks are essentially healthy after massive runs, right? So, unfortunately, if you have gotten into SoFi as a relatively new position after the earnings, you may be feeling the pain. But for a lot of us who have been following SoFi for the last couple of years, I think we should be sitting on pretty healthy averages. I'm not too sure whether I actually shared this before, but earlier on this year, I actually consolidated I had 2 or 3 different portfolios. I consolidated everything into Webull, so it's easier to manage. And I found it quite hard to do this ACATS transfer. So because of that, I actually had to sell my SoFi off in one of my previous brokerage, and there was quite a large position, and move the money through direct deposit over to Webull instead and rebuy. So during that time, I think I lost $1 or $2 on my cost basis. But in general, I think most of us should have a $7, $8 kind of cost basis on SoFi. So I think we should still be in a pretty healthy position. Anything else you guys are buying today? Yeah, so Citibank raises SoFi's price target $18 to $28. That's quite interesting because I think a lot of people have suspected for a very long time that Citibank is one of the bigger banks that uses SoFi's backend, Galileo, to run their backend. And I think, I don't think it's actually surprising to see that they raise our price target. People are buying more SoFi. I think in general, there's not much. In fact, there's no bearish news on SoFi. Nothing that has come out so far is really a concern to me. And I think this is really just, the market's taking a breather after running all the way up from Liberation Day. Yep. Okay. Yes, I did buy Grab. I own. I mean, I currently own around 9,000 shares of Grab, but honestly, I am thinking whether or not I want to trim some of that position at certain price points. And not because I'm actually bearish on the company, I'm extremely bullish on the company, as you'll find out in the next couple of videos. Grab and C Limited, actually, I mean, especially being in Singapore, I know how important these companies are to the Southeast Asian region. But I think for me, it's because it's more of a strategic play on how I actually manage my portfolio. I manage it largely using options to generate me an income. So because of that, I don't think Grab options are necessarily the easiest to trade. There's not as much liquidity. And so currently I'm locking up around $50,000 in Grab. Not too sure whether that's the best thing in the world. I'm not decided. You could say $50,000 is not too, yeah, it's not a fair, yeah, $50,000. It's not little by any stretch of the imagination. It's also not a lot that it will affect my options premium by that much. So I'm on the fence about it. Yeah, because if I look at the call options data on Grab, if I sell a covered call at $6 a month out, I get 5 cents, right? So that's slightly less than 1%, and I can get better returns elsewhere. If you go slightly nearer in 2 weeks, you can get, I guess you can get 7 cents at 550. Okay, 7 cents at 550, 2 weeks out. Let me see. 7 cents, 550. Yeah, 1.2% times 2. I mean, annual. I mean, I guess on a monthly basis, you could get 2. Yeah, I guess you can get 2.5% premium. Let me just take a look. You see the thing about this options, right? Because there's so, yeah, I'm only allowed to go in increments of 5 cents. So that's weird because I see 7 cents being the last executed price. $90. Well, I could get $840 for my 50,000 shares over 2 weeks. I think that's not too bad. If I promise to sell it off at at 550, but I think at the end of the day, I don't know whether that makes sense. I think it's quite hard as well. I'll try. I think liquidity wise for me is why I'm not really doing this. Okay, I think that's enough talking about the market for now. I just want to get into talking about Nike today, and then basically we'll see where that takes us from there. Okay, so yeah, let's get started. So, wait a minute. All right, so today basically is going to be day 2 of covering 10 companies in 10 days. And, like we have just mentioned earlier on, it's been a really red Wednesday. I mean, at the end of the last stream, like some of you were asking about SoFi. At that point in time, it was only down 3%. And then later on in the day, it was actually down a total of 6%. This morning, SoFi finds itself down a further 4 to 5%. So I think by and large, there's really whatever company that I haven't shown a video on my portfolio, but if you go on my X account, I actually screenshot some of my positions over there so you can see. But basically, I'll probably cover that at some point later on when I finish this series of live streams, because the whole reason why I want to live stream on a more regular basis is because I'm hoping to, let this become a documentation for my own, like my own trading journal, right? So I just want to be able to look back, understand my own thought process of why I do certain things, because over the last maybe 7 to 8 years when I've done it on my own, it's been rather haphazard, and then sometimes I find it quite hard to repeat that process, or there are certain things that I can't actually follow. So because of that, that is something I will plan to do in future. And so right now, this series of 10 companies in 10 days is really just to get myself into the habit of live streaming and basically get the setup right, and then we'll see where we go after these 10 days. Yeah, but I think by and large, if you have followed the channel, more or less, my positions: SoFi, HIMS, Grab. I do have one smaller portfolio with that's more of a buy and hold. I don't touch it. Things like AMD and Google are in that portfolio. But what I have over here: SoFi, Grab, UNH, Oscar, and I think more or less familiar names that we all know about. Yeah, so but the companies in this portfolio, I run option strategies on them. I manage them, and I'm not opposed to cutting certain positions when the time calls for it. However, in the buy and hold, companies like Google, Amazon, AMD, even Alibaba are in that other portfolio, which I don't plan to touch at all. Give me. All right, so I think when I was looking at the past streams, I realized there were certain things, or at least when I was looking at yesterday's streams, I realized that there were a couple of things where I can really improve on the delivery on what we are covering. And hopefully, I'll try to apply some of that today. I'm still not super familiar with how to run or where to find the buttons for some of the streaming setups. But I think yeah, beyond that, I think I'll try my best to make it a little bit easier for you to follow, especially those who are jumping into the stream halfway. Because I think yesterday, a lot of the times we were clicking all over the place. And it can be quite hard to follow, especially for people who are coming into the stream halfway. So give me a minute. All right. Okay, so today we'll be basically talking about Nike, and yeah, I don't want to make it such that it's hard to follow. So I basically have uh this timeline of what we hope to cover today, and then as we go through this, it's easier for you to look for it through those. I'll timestamp the entire live stream as well later on. At the start of every video, especially because sometimes there are not as many people watching the live streams as there are usually watching the videos. So because of that, I'm not too sure how many of you are new here. So at the start of every day, I'll just spend a short 2 to 3 minutes to run us through the framework again, because anyway, this is something new to everybody on the channel. Then we'll be talking about Nike's stock performance, why it actually pumped up recently, and then it sold off over the last couple of days. Why did Nike fail in the first place? Because I believe in terms of the stock price, it actually fell more than 60 to 70%. The new CEO has stepped in. His name is Elliot Hill. What is his plan for Nike? And then we're going to look at Nike's valuation. That is when we'll go into the Excel file. And using all this information, we will take Nike through our framework to decide what kind of company is Nike, whether or not it's a company that we can consider investing in the months ahead, right? So with that, I just want to bring us over to the framework over here. Basically, if you're new to this framework, there are a total of 8 parts, which scores a company out of 40. The disclaimer over here is that this framework is not something that is fully built out yet. Basically, what this is I spent over the last 3 weeks, perhaps, to actually reverse engineer how I found certain companies like Palantir, like HIMS, and so forth. Because when I did this on my own over the last 7 to 8 years, I had no concrete guidelines, and everything I did was more of I had a general idea and a general direction what I was looking for, but nothing concrete. So this framework actually gives us something concrete, and what we're hoping to do is to bring some of the companies through this framework, and then basically we have them. At the end of the day, we're going to have these 10 companies on a portfolio, and then we're going to track their performance over time. So the first part of this framework basically talks about the total addressable market of the company, because that is something very important. The company that we invest in needs to have a big total addressable market, and then don't just need to have a big market in front of them. They have to have the ability to go out, gain market share, and then defend that market share, which is why the second thing we want to talk about is the revenue, as well as their business model, as well as their mode. We need to know how they make money and how they're going to be able to defend themselves and separate themselves from their competitors. And so how they're going to make money is important. That's their business model. But we also want to know that they have more than one ways to make money within that same market itself. So for example, like Nike that we're talking about today, they don't just sell shoes, they sell apparel and equipments and things like that, right? So that's what we call optionality, revenue, optionality, client concentration. So that's the thought process: total addressable market, business model and moat, as well as revenues and optionality. And then thereafter, it's not just about how much money you bring in, it's how much money you can keep. So we talk about things like the margins of the company, and then we look at the balance sheet as well as the cash flow statement. So these takes us through parts 4, 5, and 6. And then finally, the last 2 segments of this framework basically talks about insider alignment. We want to invest in a company where the insiders, the C-suite, basically the management team, is aligned with shareholder interests, and we want to see a CEO that is I mean, personally, I do prefer founder-led CEOs. However, I think Anthony Noto, people like Elon Musk. They are like pseudo founders, right? So they kind of like buck the trend of this a little bit. So I have some leeway over here in terms of CEO, but I like to see companies that are eventually buying back shares. Of course, I would prefer if they're reinvesting back into the company for growth, but if they're buying back shares, especially as their growth starts to slow, as they start to turn into a mature company, that is definitely a sign of a good company, and not just how they manage the company as a whole to actually gain revenue, to increase their profitability, but how they manage risk. And I think these are the 8 parts that we actually take a company through to determine whether or not this company is investable. I don't really have all the terminologies down yet. This is really a rough framework. I'm bringing you through it, and then I'm building this and making tweaks to it along the way. And so if I make any changes along the way, I'll definitely let you know, right? So the next thing we really want to talk about is Nike's stock performance. Okay, so I think Nike over the last couple of weeks actually really had seen a bump in their price. I think this has to do with their most recent earnings. I think they actually reported better than expected earnings. I think the losses that Wall Street expected were much more severe than what was actually posted. And so I believe that Nike's EPS was only expected to come in at around 11 cents in the most recent quarter, but they posted EPS of 14 cents. And so because of that, the stock jumped. And I think it's not just because of their earnings. I think after the earnings, we also received news that the US has reached a trade agreement with Vietnam. And because of that, Nike does, I think, nearly 50%, or is it nearly 50%? I think nearly, well, where did it say? I think I read somewhere that there's basically Nike does a bunch of manufacturing in Vietnam. I can't remember the actual number now. It says 90% of On's footwear. Well, I mean, okay, but that's for On's. I think for Nike, similarly, it's a fairly sizable chunk of their of their supply chain comes from Vietnam, and so I think the trade deal was also something that boosted the stock price. Now, but despite all of this, if you take a look with me at the stock price, you can see over the last couple of years from 2020 all the way to today, basically, we are right back where we started around 5 years ago, right? In fact, this was actually pre-COVID. You can see in the middle, at the start, there's this very deep decline, and it represents the dip during the pandemic, everything we covered. And then right now, in fact, just a few weeks ago, we were at $51, and that was actually even lower than where we were in the pandemic. And so the question a lot of people are wondering is whether or not Nike is going to be a company that is going to be able to turn around their business. Now, to answer that question, I think we really have to understand what happened to Nike in the first place, right? And I think So to answer that, like I said, we have to understand why did Nike fail in the first place. Give me a minute. Let me just. Yeah, so we have to understand why did Nike fail in the first place, and I think it's a fairly interesting story, and there is a slight twist to this story at the end, which I will share at the end of the video. But I guess overall there are two main reasons that led to the decline of Nike over the last couple of years. I think the first one is really that they pulled away from their wholesale partners like Foot Locker and even selling on Amazon, and they focus more on their direct-to-consumer distribution. I think the idea that they have here is correct in the sense that they want to bring their storefronts online and to focus more on their online sales, but it really goes against Nike's culture and actually that is something that makes Nike's brand special to the consumer. And to the previous CEO, John Donahoe, I believe, he has no experience in running, or not much experience in running, a consumer-based business. Because when I went to look at his past positions, he seems to be someone who is more familiar in the tech space. I believe he was once the CEO of ServiceNow. He was also on the leadership board of PayPal as well. And so because of that, I think it makes someone like him, with his background, with his training, he actually aims to capture high margin. He wanted to control consumer data and ideally build loyalty to the Nike app itself. So it was a very tech focused way of approaching the business rather than a consumer focused way of approaching the business. And so this failure of Nike, to me, really can be attributed to a combination of factors. It's not just any one thing in particular, but together they actually cause certain operational headwinds for Nike. And I think firstly is they really moved too quickly to distance themselves from their partners. And I think what the CEO didn't understand at that point in time is that I think he saw all these other competitors like Foot Locker, like JD Sports as competitors to Nike eating into their margins. But I think what he didn't understand is the kind of foot traffic like that these companies actually brought to Nike, right? And so to a certain extent, once these partnerships started to dissolve, once Nike started to step back from these partnerships, these companies just no longer have any incentive to put Nike products onto their shelves. And it's not just Nike losing the shelf space. These companies are not just going to leave an empty shelf space over there. They're going to fill that shelf space with other brands. And that's why over the last couple of years, you start to see Adidas, New Balance, even the new company Ons, basically Ons, On. I don't know. It's such a weird company, On. Like, who names their brand just two letters, On? But anyway, yeah, you start to see brands like that fill out the spaces at all these other wholesale partners that used to partner with Nike. And so, I mean, I don't know about you, but personally, when I think about Nike or any of these sports apparel, I'm going to be the first to say that I have no brand loyalty whatsoever to any of these sports brands. To me, it's just a t-shirt that I wear to the gym or to run, and I'll just buy whatever that is in the store and preferably discount. So the only caveat over here, which I think a lot of people that know me can vouch for me, is that I will go primarily to the shop of the shirt sponsor for Liverpool, right? Because I support Liverpool. Every single year, I want to buy their jersey. And because of that, I want to buy certain apparels. And because of that, I will go to the shop with the Liverpool jersey. So actually, just last week, I went to the Adidas at Vivo City, right? So those of you who are not in Singapore, Vivo City is just a very big mall in Singapore. There's an Adidas shop over there. Walked past it, saw the latest Liverpool jersey, went in to try and buy the Liverpool jersey, came out with more, some other clothes and things like that. I even nearly bought a shoe on that day, but that's where the twist to the story later comes. I'll tell you what shoe I ended up buying at the end. And so because of that, like I said, I don't really have any brand loyalty to these brands. And so when Nike's products are no longer on the shelves of Foot Locker and of JD Sports and things like that, it just becomes a case of out of sight, out of mind. And this was really a lack of foresight by the CEO. And I think that's down to his training as someone having a tech background. And so they really suffered when these relationships with their partners deteriorated. And I think on top of that, the management really, I think, misjudged how much people actually valued going into the physical locations to shop. I mean, personally, for me, I can say that, sorry, I don't know if I'm weird to say this. Up to now, is it fair to say I haven't? Okay, my friends who are listening to this, they may correct me later on, but I'm pretty sure I have never bought a piece of clothing online. I'm going to say it again. I have never bought a piece of clothing online. Apart from supporting Yes Theory. Okay, apart from supporting Yes Theory YouTube channel. Apart from that, I have never bought a piece of clothing online. Because I'm always worried that, despite the measurements, sometimes the cutting is just something that you can't tell. The sleeves might be a little bit shorter than what you actually want and things like that. So I would always prefer to go to the actual shops. Now, I have worn clothes that my friends have bought for me online and stuff like that. Turns out fine. But personally, I prefer to go down to the physical location to actually try out the clothes. So that is for me personally. And I think the CEO at that point in time really misjudged people. And I think because he came from a tech background, it seems like everybody was on the internet, everybody was on their phone, everybody preferred mobile, just doing everything within an app. And he believed the same thing can be applied into the consumer space. And I think that isn't always true. And that was something that he found out. And so then in October of 2024, that is when Elliot Hill took over. Give me a minute, let me show you. Can I do this? Am I able to load everything? Oh, I can. Can I? I think I can load everything. Oh, okay, I've got to remove some of these. Okay. Right, now I know how it works. I think maybe next time I'll make it in a PowerPoint, see whether I can share that. Okay, so basically in October of 2024, Elliot Hill steps in. And Elliot Hill is basically someone who has spent years, I think over 30 years at Nike. When he was there previously, he was the president of consumer and marketplace. And I think strategically, this puts him in a very good place where he is well equipped to tackle some of Nike's weaknesses over the last couple of years. So he actually retired back in 2020 and really brought in as someone that is seen by the board as able to understand Nike's culture and to be able to fix the decline in Nike's culture as well as their perceived branding. And so, like I said previously, when Nike diluted its branding by going, so okay, no, I don't think I mentioned this, but I read this earlier on that Nike, one of the reasons why people saw them as diluting their brand is that they actually went after broader demographics. They went after women, men, and children, and they had three broad categories. However, previously in the past, Nike has identified themselves with certain key sports, and that is what Elliot Hill is refocusing the brand on again, back on their core sports. Such, I think yes, he said four. I only remember two right now: running and basketball. And I mean, for me personally, I have always known Nike as the basketball brand, and I have never been a basketball person. I've watched the Boston Celtics a couple of times, the Lakers a couple of times, and that's about it. Nothing too serious. I've always been a football person, and so I know, right? Adidas, impossible is nothing but, and yeah. So to me, Nike has always been a basketball brand, and I think it's good to see them going back uh, to focus on something that is really their niche. And he's focusing on rebuilding the relationships of wholesale partners. He basically has this thing where he calls it, if I'm not wrong, the win now strategy, right? So this win now strategy basically has a couple of components. So basically, I'm just summarizing it. He's trying to rebuild these relationships with wholesale partners, which the previous management pushed away. He's also trying to clear all these old inventories, because I think after a while, Nike found themselves in terms of product development a little bit out of touch compared to some of the other brands. Again, a quick hint, I didn't end up buying a Nike shoe, although I was very, very close, right? I went into the Adidas shop. I saw a shoe I liked when I was looking for the Liverpool jersey. Went into the biggest Nike store in Singapore along Orchard Road, but I ended up buying something else, and it was so out of the ordinary, I even surprised myself. Yeah, and so because of that, uh, because of these are certain ways that Elliot Hill is really thinking of building back the Nike brand, and I think that he really sees the value. I think over in the last segment over here, if you see, this is basically something that I've taken from his letter to the shareholders. I want you to pay attention to number 5. He says, we take pride in Nike standing out among sports' biggest moments, but equally important in nurturing authentic relationship with consumers in the neighborhoods where they live and play. And I believe this is in reference to their relationships with some of their wholesale partners. So we support communities to run and train together. We partner with local retailers to bring more people through their doors, and we celebrate the intersection of sport, youth, and culture. The ground game is where Nike becomes deeply personal, and our teams are obsessing those connections every single day. And I think that is where you can really see the current CEO, Elliot Hill, really understood the core values of Nike as a brand and how the consumers actually saw Nike compared to the previous owner. And so I just want to bring you very quickly right now to look at his first earnings call, right? Elliot Hill's first earnings call. Give me a minute. Let me share my screen over here. Let me share my screen over here. Okay, this is for Nike Investor Relations. I believe the first one was in December. Oh, sorry, let me just make myself smaller. Yeah. Yeah. So I can't show you the full thing, I believe, but I just want to very quickly show you over here. When he first came in during his first earnings call, this is how you tell that this is a CEO that really understands the brand. He says, I tell you this, we, the entire Nike team, feel the sense of urgency here. My full leadership team and I went on the road over the past few weeks to meet our teammates, partners, and consumers to get a first hand view of our brand and business. We went to LA, New York, Amsterdam, London, Paris, Shanghai, and Beijing. Now, together, we walked the high streets and the shopping malls of these cities, oh my goodness, to see how consumers are experiencing our brand at retail. He met with wholesale partners in each geography, all of which I already know and have developed deep relationship with over the years. So you see, this is someone that when he steps into the role, he doesn't really have to rebuild that connections because these connections were already there when he was in his previous role as president of marketing and consumer. And I think that's why when I was looking at him as an appointment for their CEO, I think it really, really makes sense for him to be put at the helm for this turnaround for Nike. And so I met with the commissioners of the NFL, the NBA, the WNBA, the MLB, as well as the NWSL, the heads of the top NCAA conferences and teams like PSG, and the past and present at like MJ, Ronaldo, Sabrina, and things like that. So he's basically really on the ground. He's trying to understand the consumer sentiment on the ground, and he really wants to make Nike this brand that is personal, that really cares about the consumer. And I think you can really see that in the way that he interacts with the stakeholders, right? So, like I said, this is through Fiscal AI. Previously, I was using Seeking Alpha over the last 1 to 2 years. Recently, swapped over to Fiscal AI. Wanted to see how it is. So far, I would say I'm actually enjoying it a little bit more. Yeah, I think primarily because the way it's laid out. But yeah, I don't know. I think in Seeking Alpha, you actually get more articles, although not all articles really make sense over there. So it really depends on what you are looking for. Okay, so back to yeah, so you can see recently back in May of this year, they also announced that it's actually the first time that Nike is resumed selling on Amazon since 2019. Now, this Nike no longer selling on Amazon, I believe, cannot be blamed on John Donahoe because he only joined as CEO in 2020, right? So this is something that is good to see that they're actually building back all these partnerships with some of their various stakeholders, which they pushed away previously. Okay, so with all of this, I believe we have what we need to just look at the valuations of Nike right now. I just want to take us through the 10K as well as the valuation, which is basically the Excel sheet that you saw previously. And I think what you're going to see is where the main concern lies. Up to now, is there any questions so far before I carry on? Let's see. Okay. No, I just want to point out a couple of things to you. So, if you were here yesterday, we were just pointing out how to look at a 10K and what the business is about. I think for Nike, I don't have to spend time telling you what their business is about. I think everybody already understands what Nike's business is about. You can see this at the start. I think you can see it. I think honestly, right, I would say that I'm not someone that is super in tune with brands. You know, it was literally just a couple of weeks ago that I learned that Converse was a part of Nike. Okay, I know it might be embarrassing, but it is true. I have no concept of brands whatsoever. So I literally just learned that Converse is a part of Nike. And you know what? I like Nike and I don't really like Converse as a brand. So I don't know. At least for me, doesn't really fit my style. Yeah, so I'm actually quite surprised that they own Converse. Yeah, so they at the start here, basically they basically tell you their entire business, what they tend to go after, right? They focus on footwear, on sports apparel and equipments and stuff like that. I won't spend too much time over here because these are things that you already know. I don't want to bore you, but I think what is important is, let's go to the financial statements. Just by the way, if you are looking at this graph over here when I'm scrolling, you can see Nike has performed worse than the Dow Jones, worse than the S&P 500. So yeah, you can see this is not a index-wide problem. This is really a Nike-only problem, right? Okay, so I think the first thing you want to look at is the change in revenue. This is why people are really worried. Investors are skeptical towards Nike. Last year, they generated $51 billion in revenue. However, this year, revenue only came in at $46.3 billion for the entire fiscal year of 2025. I think Nike has a slightly weird, reporting date. I really wish everybody just did Q1 to Q4 in the year, January to December, but yeah, apparently not Nike. Gross margins, gross profit and gross margins both declined. So you can see gross profit dropped by 14% and margins dropped from 44% to 42% over here, right? And then demand creation expense, I mean, that's a very nice way to word it. That's basically marketing spend. That definitely has increased. So you imagine you increase on your marketing spend, however, you bring in less revenue and less profit. So that is not a sustainable business model. But we have heard from Elliott Hill that right now, the main focus for them is actually to streamline their inventory, to get rid of old inventory. And I think one of the ways that he actually helps to do this by, in a way, still maintaining their margins. Despite a hit in margin, you can actually see across the 2 years, it's actually only about a 2% hit. And the reason why they are able to do that is that because rather than discount their items, he actually sells all of these older inventories that they find it harder to move at the Nike value stores instead of discounting them. And I think what that does is also protects the brand's premium image, right? So, but I think what is good and what we really want to see is that the operating overhead expense is declining. So we can see that Nike is really being quite prudent on their cost over the last year, right? So net income also declined, came in at $3.2 billion versus $5.7 billion. So I think by and large, you can see that all these fundamental missteps by Nike has led to lower revenue. Later on in their balance sheet, in their 10K, you can also see them break down where these revenues come from. The large majority of this comes from footwear, then follows by apparel and then equipment as well. Okay, and they also split this up into wholesale to customers and through Nike Direct. So hopefully we see this sale to wholesale customers start to go up as well. And then, yeah. So when it comes to gross margins, this is where later on I will have a discussion when I'm bringing Nike through the framework. But let me just bring you over here. And I just want to, is it at financials? I'm still getting used to this platform. Where did it say? Oh, okay, it says ratios over here. Oh, wait. Oh, should I have taken a screenshot of it? Is it industry? I believe it's industry. Yes, I think it's industry. So Nike's gross margins have, oh yes, fantastic. So it has the previous one that I saved over here. So basically, you look at Adidas, their gross profit margin is around 51%. Now, Nike previously were in high 40s, not that far away from Adidas. So I think that was not too bad. However, the data I was using goes as far back as 2020, 2021, 22. So even then, it's not as high as Adidas. you can see even companies like Skechers, like Crocs, have a higher gross profit margin compared to Nike. Yep. And then, yeah, even on a forward PE basis, Adidas is at 17.4, Nike is at 46.6. So I really do believe that fundamentally there is a problem at Nike. And I think the question over here is whether or not you believe that Elliot Hill is the right person to turn Nike around. Hey, Louis. Well, yeah, I mean, firstly, welcome. Secondly, Nike is really a company that I've been thinking about taking up a position in. Just for the pure reason that I wanted to have I wanted to have either Nike or Lululemon or Ons in my portfolio. Haven't decided on which one. Not in a hurry to add, which is why when you guys requested this in the comments previously, I was quite excited to do some DD on this. Yeah, later on when I get to bringing Nike through the framework, perhaps we can have a better idea on where this stands. Because I think within this next 10 days, I'm doing Nike, I'm doing Ons, but nobody actually asked me about Lululemon. I went to Lululemon recently, and I have been always holding myself back from going to Lululemon because to me it's just sports apparel. Why do I pay so much for it? But when I went there, I tried their shorts, and okay, you can say I'm a convert in that sense. So which is why I started to get interested in their company, and then yeah, so that might be a bonus after these next 10 days. But Nike, Ons, as well as Lululemon, I might be adding one of those three to the portfolio eventually, just possibly a small portion. I might not be adding it to this portfolio that I generally talk about with SoFi and HIMS and all that. I think earlier on in the stream, I was mentioning that I have two main portfolios. One of it is a more buy and hold portfolio where I hold companies like Google, AMD, Amazon, and things like that, and Alibaba. And that's possibly where I'll park that money, or where I'll park my companies such as Nike and Lululemon and things like that, because these are things that are going to take time to play out. Yeah. So okay. So back to gross margins. Yeah, I think there's no big concern over here. If you look at their balance sheet, I think the only thing is to look at their balance sheet. Let me see. Okay, let me see. I think it's easier to see over here. Balance sheet. Yeah. Okay. So if you take a look at Nike's balance sheet, cash and cash equivalents decline. That's normal, especially if they're using the money to turn around the company. Short-term investments around the same. So total over here, you can see that they have around $9 billion of cash on hand. Long-term debt, you can see over here is around $7.96 billion, right? So they actually have more cash on hand than debt. That means they are in a very safe place. The only thing is that later on, when I show you their cash flow projections, you can actually see that their cash flow is actually pretty lumpy. So it's a bit hard to project out their cash flow. It's actually not that straightforward. So with all of this, I just want to take us through looking at the Excel file right now, and then to basically extend the valuation of where Nike stands and just look at some of the graphs. So if it's too, I mean, when I was looking back at yesterday's video, I realized the fonts, especially on the Excel file, might be a little bit small. So if it is too small and you can't see it, please let me know in the comments down below, and I'll make it bigger. It's just that I'm usually used to working with slightly smaller fonts, so I'm not. Yeah, I'm not used to actually seeing some of the numbers so big. Give me a minute. Okay, so let me sharing. Okay, so what you are seeing over here is actually the quarterly numbers for Nike. I didn't use Q1, Q2, Q3 because later on I'll get confused. Basically, it starts from August 2021, November, Feb, May, so on and so forth, right? So I believe the most recent quarter that they just reported, which means technically Q2 of 2025 is actually their fourth quarter of 2025 based on their fiscal year. So you can see over here, the revenue growth has been pretty lumpy. If you just look at the numbers, let me zoom in a little bit more. Let's just look at the numbers. you can see the year-over-year revenue growth here is actually pretty lumpy. 15%, 1%, 5%, negative 0.9, 3.6, then suddenly jump 17.2, 14, then back down again 4.8. So this is on a year-over-year basis, their quarterly revenue. You can see the growth has been fairly lumpy, and then it starts to get really ugly in the last couple of quarters. 2%, 0.5, 0.3, minus 1.7, minus 10%, minus 7.7, minus 9.3, minus 12%. And then I think we see the same story with their gross margins. Like I said previously, you know, their gross margins were pretty high 2-3 years ago, towards the end of 2021, 47%, 46. It was still not as high as Adidas, but high nonetheless compared to where they are today. Today, over the last 2 quarters, they reported 41% gross margins as well as 40% gross margins today. I think the only good thing that came out of this is that eventually their EPS actually came in higher than what the street expected. The street expected an 11-cent EPS in the fourth quarter of 2025, which was the quarter that ended in May. However, they reported 14 cents of EPS over here. So you can see shares outstanding, 1.4 billion, 14 cents of EPS, right? So, okay, actually, you know what? I just realized I haven't put in the cash flow number. Let me key this in right now. So for Nike, if I go back to their financials and take a look at their free cash flow. Yep. So up to now, is there any questions or anything that anyone is unsure about when it comes to Nike before we carry on? And while I'm keying in this cash flow number, making 5 cash flow from operating force. It's wow, okay, it's low. Was 6.3. So you can see just the cash flow from operations as a percentage of overall revenue that has been declining and in fact fairly low over the last couple of quarters. CapEx spend, let me take a look. Yep, around dollars, 100 million on CapEx. So free cash flow. So did I put this in the graph later on? Yeah, I think you can see the graph over here looks really quite ugly. Okay, got all the numbers down. So what I'm going to do right now is to actually take you through the graph for Nike, and you can see why sentiment towards this company has been bad. Even I personally, despite wanting to take up a position in this company, I'm also hesitant after looking at some of these numbers. All right. Should I put myself over there? I think if I put myself over there, it's easier for you to see. Okay, so let's go through the graphs one by one before we take a look at the valuation. I mean, I'm literally doing this on the spot. I haven't keyed in the valuation number, so later on we'll be keying that in. Now, in terms of revenue growth over here, you can see that it has been stagnant, in fact declining, some would say, over the last couple. It's been stagnant to declining over the last 4 years now. August 2021, now we are in August 2025. So over the last 4 to 5 years, that has been declining. So that is the blue bars that you see over here. And then if you take a look at the orange line that has been decreasing and it's been dropping so quickly, that has been the revenue growth, right? And so you can see this is why the stock price basically has followed suit as well. And then when you look at their EBIT, oh, this is ugly. This fall off is really, really ugly over here. Their EBIT has fallen to just 2% margins. And then, the same thing with their net income. Literally fell off the cliff, right? So that is exactly where we find Nike today. Bloated, full of inventory that they cannot sell, that they have to take, if they want to move on this inventory, they either have to sell it through their vendors or through giving huge discounts. But if they give too much discounts, then they actually end up hurting their own brand image, because they are going to be seen as a cheap brand, but they want to be seen as a premium brand. However, if they do not give the discounts, they will not be able to clear all this old inventory, and it becomes a write-off for them. So they are really stuck between a rock and a hard place. And Elliott Hill is really doing the best he can to try and clear some of these inventories. And to see margins compress really over this period is nothing too, I wouldn't say it's not concerning, but I think it's not surprising. I think that's the correct word to use. It's really not surprising. And I think at the end of the day, if you really trust in how that this is someone that already has all these relationships with their wholesale partners, that manufacturers already understand him, that trust him, and he really has flattened the leadership layer at Nike so that it makes it easier for communication and for them to rebuild the brand from the inside out and to bring out that culture of Nike. Then I believe this is something that you just have to take as an investor, something you just have to accept as an investor. Because when you look at their free cash flow, it's really quite lumpy. There are certain quarters that is good, certain quarters that are bad, and it's just fairly cyclical along the way. Right. And so at the last graph that you see, which is something that I added today, is just the gross profit, because this really has tailed off over the last couple of months. This is the annual revenue over here. So you can see annual revenue has been up over the last, and then it stagnated between 2023, 2024, and then started to decline. Okay, so right now, what I want to do is to build a DCF for Nike. Give me a minute. All right, Nike's WACC today is around between 8.3 to 7.5. Okay, I mean, I see some places giving it a 9.2. Like I said, the WACC is basically your expected rate of return. So I mean, I'm comfortable with 8.9. 8.9. Yeah, I think I'm comfortable with 8.9 terminal growth rate of 3%. So the assumption, okay, so in 2025, we already know that their full year revenue for 2025, we already have the number. So we are going to just put this in. This is this is a decline of 9.8% year over year. Expectations thereafter is that Nike grows at maybe 3%. Did they give guidance? Let me just take a look. I'm so sorry. If anyone in the chat knows whether Nike gives guidance for the next year, you can let me know. The only thing I know that they gave guidance on is how much manufacturing will come up from China and things like that. That they say that will decrease over the next year. I'm just taking a look at their earnings transcript to see whether or not they actually spoke about guidance for next year. Let me see. Guidance for the first quarter, okay, very good. For the fourth quarter, was down. All right, 2026. Wholesale decline. Greater China EBIT. Okay. We have made with year-over-year declines of more than 20%. Okay, we expect some of these headwinds to continue in the first half of fiscal 2026. I think this is a comment in regards to their footwear segment, which is basically one of their biggest revenue drivers. And I think a large part of this has to do with they say this has to do with their footwear mix, and I'm assuming that what they have is really not what the consumer wants. Okay, but they do say that designs of the Air Force One is stabilizing; it's no longer declining, and they plan for larger reductions for the Nike Dunks. Okay. So they actually, in a sense, investors are glad that they can see the light at the end of the tunnel. But at the same time, he's basically saying that to expect the clearing of all this inventory to take place all the way to the end of the first half of fiscal 2026, which means December of 2025, right? So over the next 2 quarters, I think I can just share the screen over here so that you can see what I'm talking about. You can see over here, we expect these headwinds to continue. These headwinds is talking about, yeah, portfolio transition. Basically, I think the inventory that they have on hand. And we have made significant progress in managing down our classic footwear franchises with year-over-year declines of more than 20%. In Q4, these declines accelerated to 30%, presenting a $1 billion headwind to revenue, right? So which means that revenue would have been $1 billion more without these headwinds. We also finished Q4 down approximately 10 points from the peak as a percentage of our total footwear mix. So they expect these headwinds to continue into the first half of fiscal 2026. And remember, when you took a look at the revenue mix earlier on, footwear is basically their main revenue driver. But with signals that the Air Force One is stabilizing, we plan for larger reductions of the Nike Dunks over here. And there was this period of time where literally everybody in Singapore was wearing a Nike Dunks. Yeah, it was to the point that I nearly wanted to get one myself, but I decided I didn't want to be so caught up in the trend. But yes, I was really, really tempted to get one. We remain on track for a healthy and clean market by the end of the first half of fiscal 2026, which means December 2025. Over the next 2 quarters, Nike will continue liquidating excess inventory through our value stores and select value partners. Again, like you see, no discounting, right? Because they want to maintain their brand value, which means this, I think it depends on which side of the fence that you sit on. You can be skeptical and say that, oh, you see, the turnaround is going to take longer than expected. That's if you're looking for a quick turnaround. Nike is a stock that you want to trade over the short term and then just have a quick boost in earnings. And then, basically, perhaps you have gotten in the $50, $60 range and you hope to get out in the $80, $90 range. Then this is something that might be disappointing for you. But if you are someone that really believes in the brand value of Nike in the long term, especially, I'm not too sure if you actually saw the Nike ads, the one that, nobody wants you to win, but because of that, just win. And I really, really like those ads. And if you really understand the core mission of Nike, you really believe that Elliot Hill is going to turn around the business over the next couple of years, then I think right now, what he's doing is strategic in the long term in the way that he's not diminishing the brand value. It's like Apple, right? Apple never gives a discount. And I think Nike is going along that same path to protect their brand value. And that may mean that it's going to take longer to actually dispose of some of these old inventories, but that actually buys them time to actually have a better R&D to actually release better products in future. However, as an investor, then you have to understand the timeline for this turnaround. Okay, so then we expect to see modest headwinds to revenue as we lap aggressive clearance activity in the prior year. Okay, so I think right now, I would say that, from that standpoint, we know that there's going to be continued headwinds to their revenue over the next couple of quarters. Nothing too surprising over there when these numbers come in. However, we hope that it comes in better than expected. Okay, so with that, I'm comfortable with using a WACC of 8.9%, terminal growth rate. Oh, sorry, I just realized this is so small. Can you see? No? Is this the maximum? Why can't I zoom in? Okay. Let's just assume 3% growth, okay? Cash flow from operations, well, this really hasn't been pretty. Cash flow from operations, let's see, if I take a look at the cash flow from operations historically on an annual basis, okay, numbers are correct. Okay, this year is 3.69, let's call it $3.7 billion. Okay, so $3.7 billion in terms of the 3698. Okay, decline of 50% year over year, and margins 8%. Okay, now, ooh, I mean, I think it's safe to say that it's that we want to see Nike back to the mid-teens in terms of cash flow margin. This is not free cash flow, just talking about cash flow margin. Capex was negative. What was Capex? 100 was this last quarter. Capex for the full year, 3268. 3268 was their full year free cash flow. You minus this, 130. Okay, so let's see. Is this the correct formula? Okay, over revenue, negative. Let me just drag. All right, so you can see their capital expenditure as a percentage of overall revenue decline. However, their cash flow margin decline as well. I don't think we would expect them to have an 8% cash flow margin, do we? Technically, okay, let's just assume that first, and I'm just going to show you the different cases. In terms of capex spend, I think let's just assume 1.5%. I don't think that's going to change. I think right now they are aggressively cost cutting, and so because of that, not surprised to see this actually go down. But let's say things go back to normal, they will probably operate at 1.5%, and I think that's quite a healthy number. The formulas calculate everything for you over here. Okay, how much cash does Nike have on hand? I think earlier on, the numbers that we have on their balance sheet. Let me take a look. This is 7464 plus 1687. And then that 7961. All right, not much change in terms of the shares outstanding. Yeah, shares outstanding is fairly accurate. 46. $34. Wow, okay. Did I do something wrong over here, or is it just because some of these estimates are too bearish? Okay, maybe not then. Okay, this is 8%. Let's go with 10, 12, 14, 15, 15. No, I think that's more like it. Okay, I think 8% might be too bearish. Like if we assume 8%, I thought, yeah, okay. Later I'll explain how this works. I think for those of you who are familiar with this format, basically what it does is on the left-hand side, we use the perpetual approach to find the share price. On the right-hand side, we use the terminal multiple approach, and then based on that, we find an average, right? So the reason why I didn't think that there was a big difference when I adjusted all the cash flow margin to 8% is because this number over here was still around 80 over percent, but that was being held up by the terminal multiple, which we haven't really changed. So the terminal multiple, what is Nike's EV to EBITDA right now? Let me take a look. Okay, 26 times EV to EBITDA. All right, now historically, it's very hard to say historically. What were they at? Let me just show you. This is their. I think they are exactly at where their average is at. So if you are taking a look at what we are talking about is this number over here, right? Currently, this is at 20 times EV to EBITDA. I'm just going to show you this graph over here, and then you can see what I'm talking about. So if you take a look at Nike's historical EV to EBITDA, this is actually basically right on point at 26. So you can see this is basically Nike's EV to EBITDA. And then, yeah, historically, this is data since 2018. I think you can basically draw a line in the middle here and you will end up somewhere in 26. I think historically, that's where they tend to trade at. If you want to be a little bit more conservative, you can go 24, right? So I don't think that is too far-fetched to think that if Nike actually recovers, they'll be trading at 24 times EV to EBITDA over the next couple of years. So with that, Let's go back to our Excel sheet. So let's say 23 in between, right? Cash, okay, debt, everything is the same. Shares outstanding. So you can see there's a big discrepancy over here, and I think the reason for that is that Nike's cash flow hasn't been very strong, actually. It's actually been quite inconsistent, so it's actually quite hard to actually predict the margins that they'll be operating at. Even using 15%, I don't think that might be actually accurate. Let's take a look at historically what is their cash flow margins. Okay, then I'll. Can we see their margins, cash flow margins? Operating EBITDA, free cash. Okay, let's just take a look at it. Okay, so their free cash flow margin has indeed been around 15%. So I guess this is where you can actually see some of the bearishness in. So what I like to do, especially when we do this valuation, you don't adjust the valuation to suit the thesis that you want. Like I think you can, like I personally have some sort of bias towards Nike. I mean, I like their products. Of course, like I said, I have no brand loyalty whatsoever, but I like their products. I mean, I wanted to say I am wearing Nike shorts right now, but I realized I'm wearing Adidas. So, I mean, there you go, right? There's no brand loyalty over there. But at the end of the day, you need to think this through. Like, why is this happening? Why are you getting this big of a discrepancy? So, firstly, Nike doesn't have strong free cash flow, right? So, because of that, these margin assumptions are actually more or less right on point. Historically, this is where they have operated their business at, and that is what we are going to assume. Now, then another thing is that we have to realize that, perhaps 3% revenue growth for Nike might be a little too pessimistic. It depends. Management hasn't really given a guidance, which is why I use 3% now. However, the problem over here is I've been using 3% as my terminal growth rate. So I guess if you want to be academically correct, you can just use 4%, and then after that, you use the terminal growth rate of 3%. Even then, it doesn't change us by much. It's around $71, which means that today, based on its fundamentals, Nike is at fair value if you use the perpetual approach. Why I actually prefer the perpetual approach to the multiple approach, because everybody, despite whatever people want to tell you, there is a large pinch of assumptions over here when you're assuming the EV to EBITDA multiple. Now, I'm assuming this based on historical valuations, but that is not to say that in future that is going to be the valuation. The market could well decide that Nike deserves to be trading at 20 times instead of 23 times EV to EBITDA, right? So with that, the implied price, if I take the average of the perpetual approach as well as the EV to EBITDA approach, Nike's implied price is $123.68. Let's say I give a bigger margin of safety, right? Yesterday I said PayPal. I'm a little bit more certain about the turnaround story because we're starting to see signs of the turnaround. Because of that, I gave a 10% margin of safety. Over here with Nike, because the turnaround has just started, right? You might want to give a 15% margin of safety. So you can see the price target over here is then $105. Now, why is there a cross here? Because this is 37% upside. Personally, for me, I like to go for companies which I feel that there is at least a 50% upside. But there is a nuance to this discussion, which I will talk you through as I go through the framework with you. But you can see the problem that we have with Nike, right? So right now, before we go into the framework, I just want us to understand what we have discussed so far. Nike had a couple of years management. between the early 2020s all the way until 2024, where they hired Elliot Hill in October of 2024. So over the last 6 to 8 months, he has focused on trying to get rid of old inventory, trying to get the R&D team, the product development team, basically back on track, developing future products that really the consumer wants, and that is really going back to Nike's roots, going back to their core values. And I think that is something that we cannot see in the fundamentals yet, because the fundamentals that we are seeing today, right? The fundamentals that we are seeing today is basically the fundamentals of the business that has been built over the last 4 to 5 years. It is not the fundamentals of the business that Elliot Hill could possibly build in future. And that is the nuance to this discussion over here. And why I say, a lot of these valuations, and that is why whenever I start a video, I always say potential is a dangerous word. It's because people like to assume things. If I assume, Nike is going to go back to 19% growth, suddenly I can say that Nike is a $200 stock, but I think that is really out of the realm of possibility. And for me, if Nike grows at 19%, I will be pleasantly surprised, right? And I rather let myself be surprised by upside than to be surprised by downside, which is why, because management hasn't really given us much guidance, especially because they said that first half of fiscal 2026, headwinds from footwear, I'm going to take it as 4% growth in 2026. And to project out how this turnaround is going to play out over the next couple of years is really a shot in the dark, right? It's really a wild guess. So I don't want to be too aggressive with my assumptions over here. So because of that, 4%, terminal growth rate 3%, margins eventually growing back up to 15%. Why? Because historically, that's where their margins are at, between 10, 12, 15%. They've been always oscillating in that range. CapEx spend 1.5% times of 1.5% of revenue, and then with that you get a share price of $71, EV to EBITDA multiple 23. You get $176 over there. Like I said, I take a little less. I take the multiple approach with a little bit more of a pinch of salt, because like I said, there's a large anything with too much assumption I don't really like, right? I just like to deal with the data and the facts that are in front of me. So because of that, 15% margin of safety, even if I give a 10% margin of safety, I believe this is just under where I would feel safe buying the company, right? Like there's only a 45% upside. Risk to reward wise, perhaps, I don't know whether you consider that as, would you buy Nike for a potentially 45% upside? I don't know. Depending on how long this turnaround will take and how long it takes for the market to recognize, then that is where that framework that we have come into play, right? So with that, let's go on to discuss about the framework that we have. Honestly, why is this framework always so small every time I open this file? I have absolutely no idea. Give me a minute. You know what? Give me a minute. Let me just... All right. Okay, this is that. Let me share my screen again. Where is it? Okay, I think it's working now. All right. So, sorry, let me zoom this in a little bit. Okay, we're going to change this over here to Nike. Sorry, I realized, is this better? Okay, so you can ignore the score because this was PayPal score. So is the TAM bigger than 10x of revenue? Now, Nike's revenue came in at $46 billion. Okay, if you look at the TAM, I will show you this picture over here. I'm going to show you this picture over here. This is the TAM that we have of Nike right now. Basically, over this year, it is based on 2023 data. You have it at around $335 billion, right? Possibly growing to $646 billion by 2030, which represents a 9.9% CAGR. Okay. However, that is only from Grandview Research, because when I look at Fortune Business Insights, they actually put this at a 7.84% CAGR, and they say that it's only a 206 billion market in 2024, growing to 350 billion in 2032. So which report do I take? Honestly, usually I'll just take somewhere in between, because a lot of these, a lot of these research is basically their own research. There could be slight deviations in the way that they conduct their research, which actually is why there's these different numbers. And so because of that, I sometimes just take a midpoint between there. So which means I assume the market to be somewhere between 350 to 600 billion dollars by 2032, and then this will represent around 8% CAGR from where we are today, right? So if you look at it from that lens, give me a minute. If you look at it from that lens, with a $46 billion, with a $46 billion, oh my goodness, my English, with a $46 billion revenue, I'm so sorry, they're actually still more than 10% of the overall TAM, right? And if they are more than 10% of overall TAM, which means that this then falls to the second category of the TAM being 5 to 9 times of revenue. Now, this is also another very important graph that you need to see over here. This represents the market share and what you in 2024, and what you can see is that Nike's market share has dropped from 15.2% to 14.1%. Right. However, where do we see an increase in market share? We see an increase in market share in Adidas, in companies like New Balance, and Ons is increased from 0.8 to 1%, as well as Hoka. Now, I personally never really worn a Hoka, never seen many people wearing a Hoka in Singapore. In Singapore, I think Ons is getting more and more popular, as well as Adidas and New Balance, right? So I think I'm not surprised to actually see these are the companies that are actually gaining in market share, because these are the companies that have really rebranded themselves, especially New Balance. I'm really excited by New Balance's rebrand. I like their products and things like that. When I went to China, when I went to Korea, New Balances all over the place, products fantastic, right? And so that is why I believe, this graph is really showing us the dynamics of things that are at play right now and the competition that Nike is really going up against. So with this, these two things in mind, let's go back to our with these two things in mind, let's go back to our Excel spreadsheet over here. So TAM, it's definitely not 10 times of revenue. So it is only 5 to 9 times of revenue. Second thing over here, so you can see the number over here will change accordingly, right? Is the TAM growing at more than a 10% CAGR? No. First report gave us 9.9. Second report gave us 7.84, 7.48. And so basically we're getting in between around 8%. So definitely not 10% CAGR. And I mean, the description here is true, right? There are a couple of new verticals. I mean, but to a large extent, I mean, it's sportswear, right? How many verticals can you go into? I think it's just coming up with different kind of footwear for runners and for different sports and things like that. So there are possible new verticals for sure. In terms of disruption, I'm not really sure about that. Simple to explain, of course, simple to explain, right? They manufacture shoes, they manufacture apparels, they sell shoes, sell apparels, and then they make money, right? Okay, so moat, is there any switching cost? I would say no. Nothing is stopping me from walking into Adidas tomorrow and buying a pair of shoes from them instead of Nike. No switching cost. Network effects. I think I would want, initially I put no. After understanding the whole ecosystem behind distributors, behind their wholesale partners, I would say yes, there is, because the more wholesale partners that they have, the easier it is for Nike to get their brand out there. Is to it raises their brand awareness. It puts their products in front of more foot traffic, in front of the eyes of more consumers. And so I think as they grow this chain of partners that they have, these wholesale partners that they have, there is network effects over there, right? And at the same time, I think the more people use their app, which is why, like I said, what I really like about Elliot Hill is that he didn't just scrape the whole DTC component of Nike, but he said, let's do it right while focusing on our core values. And so what happens is that the app has become more focused on quality and understanding the consumer and delivering personalized solutions, personalized products. And so because of that, I do think that in terms of the app, there is network effects. Now, in these two instances, the moat has definitely been eroded from where it was 10 years ago. However, I think they are in the midst of building this back up. So 0.5 over here. Low cost advantage, I wouldn't say so. I mean, I guess you can say, look, there's nothing. I think someone asked me previously, what's the difference between low cost advantage and economies of scale? Low cost advantage usually means that there's some structural advantages within your business, like Tesla. Tesla builds the machine that builds the car. And so because of that, they can manufacture at lower cost. Nike, yes, they can move their manufacturing place from China, from Vietnam to India, and wherever they want to move. But so can any other company. That's the first thing. Secondly, with tariffs, I mean, this is not something that I would consider a huge moat, right? Anybody has, and it's not really a moat that is easily defensible. Economies of scale, they do have, because they are Nike, right? If you want to come up with your own sports brand, you go to a distributor, you ask them to can I make 100 pairs of shoes? Either they're not going to even listen to you, or they're going to quote you a very high price. Nike, that's not going to happen, right? Regulatory framework, I'm really struggling for this, but I don't think there's regulatory frameworks when it comes to fashion. I mean, from countries to countries. I would guess you would say tariff is a regulatory framework, right? Sort of. I mean, in certain administrations you might have them, in certain administrations you won't. But then, if that is the case, it's not even something that's good for Nike. It's something that's actually bad for them. No moat, 0. If you disagree with me, let me know down in the comments below. Feel free, no problem. I mean, this is what the whole framework is here for, so that we can discuss some of these ideas, because it's not black and white, and then I'll refine it as we go along. I'm just going to stick to this for the next 10 days. Intangible assets, like I said, strengthening, clear moat, not insurmountable, right? Everybody knows Nike, but everybody knows Nike, so what? It didn't stop their decline over the last 5 years. So there is a clear moat, but it is not insurmountable. We have seen them lose market share, and we have seen other companies gain market share. Revenue growth, definitely slower than TEM over the last couple of... So this is where the nuance come in. If you can really penalize them and say that if you look at the fundamentals, right? The fundamentals don't tell me that this is a good company. Full stop. The story behind it, however, is Elliot Hill has just come back in 6 months ago. He's turning around the company. How much do you trust him? And that is the nuance in the discussion we're having. So revenue in line or slower with them, so you can see 0 over here. Revenue growth, well, if you base on the last couple of quarters, may I remind you, the last couple of quarters, 0.5, 0.3, -9, -10, -4%, right? So lower than 5%, low to declining. Does this mean that in future it will always be low to declining? No. Does this mean that this makes it an uninvestable stock? To a certain extent, if you have 100% based on fundamentals, yes, it does. But if you understand the story behind it, that is where you can find alpha with the market. And that's what makes investing so interesting and so exciting for me, right? So yes, there's nothing wrong. I think people, when we do these Excel spreadsheets, when we come up with our valuations, we want the numbers and the results to appear nice. To me, I don't care what the results come out, as long as I'm able to justify the reason for the result. And if I understand that justification, if I believe in the story behind that justification, that is where I can actually find alpha over the market. If everybody looks at it, everybody knows what is going to happen, then there's no money to be made, right? Because everybody will be piling in. The reason why you are making money is because you have a point of view, you have certain data that back up your beliefs, that is different from the market. You invest in those beliefs, you actually put your dollar towards those beliefs, and then when it is actually proven right, the market will eventually reward you when people later on come back and put their money into the company that you have already put your money into long ago. Optionality, multiple scalable revenue streams. Okay, I think this is correct. Yeah, it's not one dominant. right? Because if I'm not wrong, apparel is actually fairly strong as well. They can easily pivot into new TAMs. Now, new TAMs, not new TAMs. Yeah, I mean, I guess so. Apparel, within the TAM itself, I think they can penetrate many different verticals. That's fine. No customer concentration, I think that's for sure. Moderate gross margins relative to industry. High gross margin, okay, I think they're moderate. I don't think they're high relative to their industry. We have seen earlier on that there are other companies out there with better margins than them. Even historically, over the last 5 years, they were high 40s, whereas Adidas is in around 51%. So there is space for improvement, especially if they continue to be disciplined on their cost structure. I believe they can perhaps even get above 50% margins as well. So there is strong cost control with fairly low fixed costs, and I give them that because of this. Okay. Because if you follow Nike, I think one of the things that has been quite scary for the company is having to do with tariffs, or what really scares the investor is that Nike has to deal with tariffs. And if you take a look over here, yeah, they're actually diversifying sorry. They are diversifying their imports from 16% currently. China represents roughly 16% of the footwear we import into the United States. We expect to reduce this to the high single-digit range by fiscal 2025. Okay, on top of this, this is what I really want to point out. And last, we will evaluate corporate cost reduction as appropriate. However, our highest priority right now continues to be reigniting brand momentum through sport and stabilizing our business. With the new tariff rates in place today, we estimate a gross incremental cost increase to Nike of approximately $1 billion, which means that they will increase $1 billion in terms of their total cost throughout the full year. We intend to, listen to this, fully mitigate the impact of these headwinds over time as we implement and annualize the actions I have outlined. For fiscal 2026, we expect this financial impact of net actions described earlier to be approximately 75 basis points to gross margins, with a greater impact in the first half. So you can see they actually do have a plan to more or less offset the cost of the tariffs by being so their gross margins may actually decline. However, if they are able to actually maintain their operational costs, they can actually still drop the same amount of money down to the bottom line, right? So you imagine if you're making $100, if you have $100 shoe, instead of spending $60 to make the shoe, now you're perhaps spending $65 to make the shoe. Out of this $35, if you only spend $15 on your operating expenses, you can bring $20 down to the bottom line, which is the same as if the shoe was $60. Yeah. Okay, you know what? Rather than say it out, let me just type it out for you as I. So for those of you who don't understand me just now when I was rambling, sometimes I like to talk like this. Imagine you have a shoe that, oh, can I draw? Oh, wow, I can draw. Okay, imagine if you have a shoe that costs $100, right? You minus the cost of the shoe. The cost of the shoe, let's say, is $50. And you end up with $50. And from there, your operating expenses is perhaps $40. And so because of that, you're left with a $10 of net income, right? I think what Nike is saying is that yes, $100 for the shoe. Perhaps because of tariffs, okay, this is going to cost $55, which means on a gross profit margin, okay, maybe we are at $45. Now, that's not exactly what they say, because they actually did say that a 75 basis points impact to their gross margins, but I'm just showing you what it means, that they can actually do other things within their business to actually handle the impact of the tariffs. Instead of using $40, right, on their operational expenses, they are able to use $35 for their operational expenses. At the end, you still have a $10 net income per shoe, right? So to me, that is showing that Nike has the ability to have very stringent cost controls, and so because of that, I'm actually not worried about their business overall. So strong cost control, low fixed costs. Balance sheet, manageable debt, goodwill, yes, not too much. They're not net cash, are they? Oh, slightly, if you count the short term. Yeah, but their debt is not, I think it's a 1-to-1. I think, like I said, maybe I should use this, yeah, use some kind of ratio to determine rather than let it be so arbitrary. But anyway, goodwill less than 30%, yes. Cash flow, it's not negative, it's, yeah, positive but not growing. Yeah, positive but not growing. So 0. CEO experience, good track record, definitely. I wouldn't know whether or not he's visionary 0.5. Yeah. Okay. Reducing debt, haven't been reducing. They haven't really been reducing debt, but there's no risk. So 0.5. There's no need to, right? Their cash can fully pay off their debt. Their cash and short-term investments can fully pay off their debt. No risk over there. Exit unprofitable segments. They don't really have unprofitable segments, but they have inventory from the past that they are actively working towards. Now, just a very quick note over here. Why is it when I'm actively working towards it is a 0, and when there's no risk, then it's a 0.5? Well, if there's no risk, means the company is already being run well in that aspect there. In terms of risk management, it is already in place. The risk is already handled. So it's accretive to the business. However, if you are handling the risk, there is a chance that you fail to handle the risk, or the risk will still emerge further down the line because it is not fully handled, which is why it is not a bad thing. We don't penalize the company, but we don't reward the company by adding a 0.5 as well. Actively working towards. They diversify their suppliers and customers, actively working towards. They actually push them away. Now they are, working towards it. And I think this might be something that eventually we can turn to low to no risk, especially because Elliot Hill is somebody that already has all these connections in his previous work with Nike, right? Simplify operations. Yes, he already said he flattened the leadership structure, makes it easier for it to communicate ideas and things like that, actively working towards. So I know it seems like, hey, I'm taking away points, but it's because these are things that are, okay, maybe we can, he already factored, right? So I guess we can already say, it's just that I think for a lot of this, I feel very hesitant to give the points because we haven't seen evidence of it working. He has taken steps towards it. You know what? He has already said that he has flattened the leadership structure in Nike to make it easier for him to be on the ground within the business and for ideas to be passed up to him. So for that, I'll give him that. Improve liquidity. There's no need for that. No unnecessary M&A. Okay, so 4 points over here. Core business survive downturns. I mean, we have seen that it has survived. Suffers? I don't know how many of you agree with me. Does Nike suffer in the downturn? I think if we do get a weaker economy, I think Nike suffers. I don't think they will survive in a sense of continue to be profitable. I think survive is not right, but maybe continue to be profitable should be the more accurate description. But I think suffers in downturns. They do, right? I think you can correct me down if I'm wrong, but I think they do suffer in a downturn, and they have suffered over the last couple of years. Longevity, 10 plus years, survive multiple cycles. Yes. Okay, fine. So I think with that, let's take a look. Nike is oh my goodness, 19.5. Oh, so if you remember our scoring, story driven was where PayPal ended up with. I think I have PayPal as a tab over here somewhere. I didn't delete the file. PayPal is a tab over here. This is PayPal from yesterday. Why can't I click on it? Yeah, this is PayPal from yesterday. PayPal was story driven, but if you take a look, and I will make another copy of this file, you can see Nike is actually weak or in transition. And I think this is very, very accurate in terms of describing where this company is at. This company has been mismanaged over the last couple of years. Elliot Hill has come in. He has put certain things in place to actually turn the company around. Fundamentally, the company is in a very weak and precarious position because of previous management that has nothing to do with Elliot Hill. Right. This framework puts a lot of emphasis on cash flow, on balance sheet, on the health of the business, because we are looking for compounders. Am I saying that Nike is not a compounder? That is not what I'm saying. I'm saying that Elliot Hill could be the person to turn Nike into a compounder, but right now they are not a compounder. because of previous management. Then you have to go into the nuanced discussion on whether or not you believe Elliott Hill is the person to turn Nike in the right direction. And like I said, he has done a couple of things for Nike so far. He has tried to rebuild these wholesale partnerships because of his relationships with these wholesalers in the past. It's easier for him to rebuild these relationships. He's clearing old inventory so that new inventory can come and take the place. They have been losing market share, but they're ready to actually now go on the offensive once again. Again, this is going to be towards the back half of 2026, right? Fiscal 2026. That's what he has told us, at least in the footwear segment, which is their main revenue driver. On top of that, he has actually divested away from China, having 16% of footwear imported into the US from China. Now it's going to be high single digits in 2026. That's going to be some cost savings from the tariffs. And then especially if you consider the way that he plans to manage costs, the $1 billion impact by tariffs to him can be managed within the company. So because of that, I think 19.5 is exactly the score that Nike deserves right now. Because right now, the fundamentals of the company, imagine Elliott Hill wasn't here and John Donahoe was here as the CEO. We wouldn't be talking about Nike as a turnaround play, because it would still have been the old CEO that led them to this point, and the fundamentals reflected that. You just have to bear in mind that 6 months ago, someone new came in, he has put things in place. Now the question facing the investor today is whether or not you choose to invest in Nike because you believe in Elliott Hill, because you believe in all these things that we have discussed today, despite knowing that fundamentally the company is not in the best place. However, I do want to say that they are not in any risk of going bankrupt whatsoever. That is for sure. But to say that these things that he has implemented will definitely work, and from here it is only up, that is also something that everyone has to decide for themselves. We can't really know for sure. Like I said, for me personally, I've wanted to take up a position in one of these retailers, either Nike, Lululemon, or On Holdings, and I'll be deciding on that at the end of these 10 days. And I think for me, one of the other considerations that I'm not sure you may have is how volatile the company is, because usually I like to run some option strategies on these companies, and companies like Grab already hinder my ability to run an option strategy because it is not the most liquid stock. So because of that, I can't have too many companies within the portfolio that are in that situation where liquidity is an issue. Because of that, that will also be something that influences my decision. So with all that said, I think we have come to the end of this. So far, we have PayPal, a story-driven company, Nike, weak company that is in transition. And I think that is exactly where we find this behemoth of a company with Elliott Hill back in charge, with the things that he has put in place. If you really believe in the turnaround story and you buy today, you're definitely getting a much better price than people who are waiting for the turnaround to actually take effect, to actually see signs of a turnaround before getting in. Because by the time you see signs for the turnaround, by the time you see signs that the turnaround is successful, Nike is not going to be trading in the 60s and 70s anymore. It's likely going to be trading much higher in the 80s or even $90 range. And so where you enter the company depends on your risk appetite, your investment style, and how much you actually believe in the company. And then that's why we call it risk-adjusted returns. And with that, I will see you in the next one. Oh, wait, someone asked me, what are the 10 companies that you're going to talk about over the next 10 days so that I can plan my time? I did a slide for that. So if you switched off too fast, unfortunately, this tells you always stay to the end. Give me a second. If there are more companies that you want me to talk about, please let me know. I plan to do this frequently, not the 10 companies in 10 days. I will do a deep dive fairly frequently because I like always to look for companies. Do I really want to go out and say I'm going to do one a week? Maybe one every fortnight. I think that's doable because I still want to cover primarily the companies that the companies that I hold. That's number one. I want to cover option strategies that I use because I have nobody to talk about option strategies to other than people on the internet that I've never met before. So there's that. And then yeah, I mean, like I said, I really want to use this as a place to share what I've learned over the years, and to act as my own journal for the way I manage my portfolio. Like, because I think if you were with me yesterday, you would remember I said, "Oh my goodness, sorry, I seriously can't multitask. Where the heck is my?" Yeah. Okay. Let me. Okay, while this is loading, image file. All right, so this is really for the bunch of you who have stayed to the end. These are the dates for the next 10 live stream. It's going to be on every single weekday. And we're going to cover 10 companies in 10 days. Tomorrow is going to be C Limited, which is basically a competitor to Grab, somewhat of a competitor. I think they are a little bit misunderstood. Then we're going to do Enphase on Friday. And then next week, we're going to do Nubank, Oscar, Ons Holding, which is the twist actually, because I was at Adidas and Nike looking for shoes. And then when I was walking back to my car park, past the departmental store, I saw Ons. I went on, I tried the shoe, and I am not a runner, by the way. I don't really like running. I run because I have to, out of obligation, for fitness, for health, not because I like running by any stretch of the imagination. I wore their shoe, and oh my goodness, their shoes are so much more comfortable than Nike and Adidas, and I ended up buying their shoe instead. And that is when I took out my portfolio and look at them and see whether or not I really want to include them as my investment. But I decided, you know what, I'm going to hold my horses, finish this 10 days, and then decide. Affirm, 28th of August, Duolingo, LifeMD. Actually, honestly, right now, I'm not too impressed with LifeMD based on whatever I've seen. But I haven't dived as deeply into that compared to some of the other companies that are coming up soon. And then you see Uber and Airbnb below, right? Uber and Airbnb are like honorable mentions. People have asked about them, but they fall out of the 10 days. Things like ASTS, Nebius, people have asked about it. They don't fit into the 10 days. And honestly, it's also because, especially for companies like ASTS and Nebius, right? When it comes to these kind of tech companies, it's very easy to just look at the financials and say that, yes, I know the company is going to grow well and things like that. But I think it's like understanding SoFi. You have to understand banking and finance in order to understand SoFi's business. You can't just say, oh, slap a growth number onto the revenue. And so because of that, I haven't decided when I'm going to do ASTS and Nebius, but I will definitely get to these two companies. And so, like I said, right, I'm very tempted to just keep going 10 companies in 10 days and then bonus 2 days, 11 and 12, Uber and Airbnb. But thereafter, how often I want to do this, yeah, you leave it down in the comments below what you actually want to see. But I think for me, deep dives every fortnightly seem doable to me because on the main streams, I just want to cover market news. I want to cover how I manage the portfolio in terms of my option strategies. And yeah, basically talk about some of the main holdings that we have, right? Google, AMD, Nvidia, SoFi, companies like that, HIMS, and Grab. So with that, I will really, 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 really see you in the next one. Oh, and yesterday I forgot to end my stream. I just exited the studio. So I'm going to do it correctly now. See you tomorrow.